All right, welcome back everyone. So, we are going to start a new series from today onwards, in which we are going to cover the book Trading in the Zone by Sir Mark Douglas. So, talking about Sir Mark Douglas, we have already covered one book in the previous series itself, that was The Disciplined Trader. In case if you have missed it, so go through it as soon as possible. And talking about this particular book and what is the significance of it, since we are starting from today onwards, so let me quickly talk about it. So, in this particular book, we are going to understand about the more technical terms, right? How can we trade right in the market itself, and what are the do's and what are the don'ts? Okay, so as the front cover itself says, master the market with confidence, discipline, and a winning attitude. So, last book was about how can we understand, like it was more on the psychological part, and in this also there will be like psychological part covered, but along with that we are going to understand more technical terms as well. Okay, so stay with me as we covered the last book. Similarly, we are going to cover this book as well. So one chapter at a time. Let's see how many chapters do we have over here. So if I'll talk about the table of contents, there are 11 chapter. So in the discipline trader there was 16 chapter. Okay, and there are sub part of one chapter as well. So let's start from the first chapter itself. Forward, preface, and attitude survey. In case if you want to do it, just you can ask me for the link, or you can even get it directly from the Google itself. Okay, and you can read it yourself. We'll start with the content itself. There is a chapter one that says the road to success: fundamental, technical, or mental analysis. Okay, now here it comes. Yes, let me zoom it a bit. Okay. Chapter 1, the road to success: fundamental, technical, or mental analysis. There is a question mark. That means it is the author is trying to ask us, like, what do we think is the most important out of these three, right? So, if you have anything in mind, just keep a record of it, write it down, and after completing the chapter, let's see if there is any change in it or not. Okay. Like, you can also set it in chronological order, like which one, if you think all three of them are important, so you can set them in a chronological order, which one is the which one is of highest priority, and the second one, and the one that is having the least priority. Okay, now in the beginning, fundamental analysis. Who remembers when fundamental analysis was considered the only real or proper way to make trading decisions? When I started trading in 1978, so as I said, Sir Mark Douglas, he holds a great experience in the market itself, right? Now, when he started trading, that is in 1978, way before when I was even born. I think 21 years ago when I even born. Okay. Now, technical analysis was used by only a handful of traders who were considered by the set of the market community to be, at the very least, crazy. As difficult as it is to believe now, it wasn't very long ago when Wall Street and most of the major funds and financial institutions thought that fundamental technical analysis was some form of mystical hocus pocus, right? Like something that is only accessible to only few, and it has some mystical powers and stuff. Technical analysis, and nowadays it is very common. Okay, now you have to have a good grab over technical analysis, fundamental analysis, and the mental, psychology as well. Then only you'll be able to survive in the market. Now, of course, just the opposite is true. Almost all experienced traders use some form of technical analysis to help them formulate their trading strategies, right? So if you're in the market and you're seriously pursuing, trading, then you know that we all have some kind of strategy that we use. Strategy is nothing but a edge, but just an edge that help us to identify where we are supposed to enter and where we are supposed to exit. Like it will give us some, what I can say, upper hand based on the previous data. Again, it can be completely right most of the time and can be drastically wrong also, because market itself is random, no? But yeah, except for some small isolated pockets in the academic community, the purely fundamental analysis is virtually extinct. What caused the dramatic shift in perspective? I'm sure it's no surprise to anyone that the answer to this question is very simple. Money. The problem with making trading decisions from a strictly fundamental perspective is the inherent different difficulty of making money consistently using this approach. For those of you who may not be familiar with fundamental analysis, let me explain. Okay, now is the important part. What is fundamental analysis? Right, some of you are already aware of it. In case if you don't know, now here is the definition part. Fundamental analysis attempts to take into consideration all the variables that could affect the relative balance or imbalance between the supply of the possible demand for any particular stock, commodity, or financial instrument. Okay, so fundamental analysis are more or less like factors that can affect the supply or demand of a particular stock or particular, wherever you are trading, basically commodity or financial instrument. Okay, using primarily mathematical models that weigh the significance of a variety of factors, interest rates, balance sheets, weather patterns, and numerous others, the analysts project that the price should be at some point in the future. Okay, so that is what known as fundamental analysis. Okay, now the problem with these models is that they rarely, if ever, factor in one in other traders are if ever factors in other traders are traders as variables. Okay, what does that mean? The problem with these models is that they rarely, if ever, factor in other trader as variables. Okay, people expressing their beliefs and expectation about the future make prices move, not models, right? Hmm. Okay. The fact that a model makes a logical and reasonable projection based on all the relevant variables is not of much value if the traders who are responsible for most of the trading volume are not aware of the model or don't believe in it. Right. So that's the tricky part with fundamental analysis. Every person who is trading in the market should be aware of this fundamental, like how exactly it works, and everyone, or the technical analysis, and everyone, not just they know about it, they also believe in it. Then only it can work for all of us at the same time. But that's not the truth, right? So most of us, or like in the market we can say most of us are, maybe let's say, give ourselves the benefit of doubt, let's say most of us know about this technical analysis and fundamental analysis, and we do believe in it. But there are a set of people who don't believe in it. Then if they will not follow it, they will not believe it, they can also change the demand and supply of the market, right? So maybe there are certain people who know about it, but they don't believe in it. Again, back to the square one, they can also make the market move, and not in terms of the fundamental or technical analysis. Okay. As a matter of fact, many traders, especially those on the floors of the future exchange, who have the ability to move prices very dramatically in one direction or the other, usually don't have the slightest concept of the fundamental supply and demand factors that are supposed to affect prices. Furthermore, at any given moment, much of their trading activity is prompted by a response to emotional factors that are completely outside the parameters of the fundamental model, right? In case if you haven't come across this, so maybe in future, and hopefully when you come across this, you know that how to tackle it or how to handle it, right? So basically, just give me 1 second. Why I'm not able to copy paste it? In case someone is watching my video for the first time, so what I'm trying to do in between is I'm taking a note of the important factors. So I'm just copy pasting stuff and making a separate sheet or PPT where I'm noting down the things that I find important. Okay. So in between, if you feel like I am taking a pause or something, so that's the reason behind it. All right. Sorry if any inconvenience occurred, as I say in the corporate world. Right. Okay. In other words, the people who trade and consequently move prices don't always act in a rational manner because they do follow their emotions. Ultimately, the fundamental analyst could find that a prediction about where prices should be at some point in the future is correct, But in the meantime, price movement could be so volatile that it would be very difficult, if not impossible, to stay in a trade in order to realize the objective. Right. The shift to technical analysis. So far we understood about the fundamental analysis that has all the data like balance sheet and stuff, and how the demand and supply of that particular stock commodity commodity, or that financial instrument can change. Now we are talking about the technical analysis. Analysis has been around for as long as there have been organized markets in the form of exchanges. But the trading community didn't accept technical analysis as viable tool for making money until the late 1970s or early 1980s. Here's what the analyst knew that it took the mainstream market community generations to catch on to. A finite number of traders participate in the market on any given day, week, or month. Many of these traders do the same lines of things over and over in their attempt to make money. In other words, individuals develop behavior patterns, and a group of individuals interacting with one another on a consistent basis form collective behavior patterns. These behavior patterns are observable and quantifiable, and they repeat themselves with statistical reliability. Technical analysis is a method that organizes this collective behavior into indefinable patterns that can give a clear indication of when there is a great probability of one thing happening over another. In a sense, technical analysis allows you to get into the mind of the market to anticipate what's likely to happen next based on the kind of patterns the market generated at some previous moment, right? So the candle patterns, the chart patterns, or whatever you are analyzing, that all comes under the definition of what? Under the definition of technical analysis. Okay, let me just add this one. Okay, all right, let's go back. As a method of projecting future price movement, technical analysis has turned out to be far superior to a purely fundamental approach. Okay, it is way better than the fundamental analysis. It keeps the trader focused on what the market is doing now in relation to what it has done in the past, instead of focusing on what the market should be doing based solely on what is logical and reasonable as determined by mathematical model. That's what we are doing in the case of fundamental analysis, right? We are using the all data related to that particular stock and stuff, correct? And then we are doing the mathematical part of it. On the other hand, fundamental analysis creates what I call a reality gap between what should be and what is. The reality gap makes it extremely difficult to make anything but very long term prediction that can be difficult to exploit even if they are correct. In contrast, technical analysis do not closes this reality gap but also make available to the trader a virtually unlimited number of possibilities to take advantage of. The technical approach opens up many more possibilities because it identifies how the same repeatable behavior patterns occur in every time frame, moment to moment, daily, weekly, yearly, and every time span in between. In other words, technical analysis turns the market into an endless stream of opportunity to enrich oneself. Okay, so basic idea we got about technical analysis is that it is better than the fundamental analysis and stuff. Okay, so whenever we say we have to do technical analysis, we're checking the past data and we're checking the patterns, and on the basis of that, we are trying to find out what could happen or what will happen in the future. Right. The shift to mental analysis. If technical analysis works so well, why would more and more of the trading community shift their focus from technical analysis of the market to mental analysis of themselves? Now I am at this stage. I've started with the fundamental analysis, then I did the technical analysis. Now I'm like, it is not that you are going to against the market. It is always you versus you. Market is just like a mirror that will reflect whatever is inside you. Okay. Now you may not be able to understand what I'm trying to say, or maybe you are able to understand what I'm trying to say because you've gone through the previous book. And if you hold some experience in the market, you can relate to this part. Right. If technical analysis works so well, why would more and more of the trading community shift their focus from technical analysis of the market to mental analysis of themselves, not market, themselves, meaning their own individual trading psychology? To answer this question, you probably don't have to do anything more than ask yourself why you bought this book, right? In your case, you can ask yourself why you are in this video, why this video attracted you in one way or another. Right. The most likely reason is that you are dissatisfied with the difference between what you perceive as the ultimate potential to make money and what you end up with on the bottom line. There's this there's the problem with the technical analysis. If you want to call it a problem, once you learn to identify patterns and read the market, you find there a limit, like you can find there are limitless opportunities to make money. But as I'm sure you already know, there can also be a huge gap between what you understand about the market and your ability to transform that knowledge into consistent profit or a steadily rising equity curve. Think about the number of times you have looked at a price chart and said to yourself, it looks like the market is going up or down, as the case may be. And what you thought was going to happen actually happened, but you did nothing except watch the market move while you anguished over all the money you could have made. There's a big difference between predicting that something will happen in the market and thinking about all the money you could have made and the reality of actually getting into and out of trades. I call the difference, and others like it, a psychological gap. Okay, that can make trading one of the most difficult endeavors you could choose to undertake, and certainly one of the most mysterious to master. The big question is, can trading be mastered? Is it possible to experience trading with the same ease and simplicity implied when you are only watching the market and thinking about success, as opposed to actually having to put on and take off trades? Not only is the answer an equivocal yes, but that's also exactly what this book is designed to give you, the insight and understanding you need about yourself. Okay, and about the nature of trading. So the result is that actually doing it because as easy, simple, and stress free as when you are just watching the market and thinking about doing it. This may seem like a tall order, and to some of you, it may even seem impossible, but it is not. There are people who have mastered the art of trading, who have closed the gap between the possibilities available and their bottom line performance. But as you might expect, these winners are relatively few in numbers compared with the numbers of traders who experience varying degrees of frustration all the way to extreme exasperation, wondering why they can't create the consistent success they so desperately desire. In fact, the difference between these two groups of traders, the consistent winners and everyone else, are analogous to the difference between the Earth and the Moon. The Earth and Moon are both celestial bodies that exist in the same solar system, so they do not they do have something in common, but they are as different in nature and characteristics as night and day. By the same token, anyone who puts on a trade can claim to be a trader, but when you compare the characteristics of the handful of consistent winners with the characteristics of the most other traders, you'll find they are also as different as night and day. If going to the moon represents consistent success as a trader, we can say that going to the moon is possible. The journey is extremely difficult and only a handful of people have made it. From our perspective here on Earth, the moon is usually visible every night, and it seems so close that we could just reach out and touch it. Trading successfully feels the same way. On any given day, week or month, the markets make available vast amounts of money to anyone who has the capacity to put on a trade. Since the market are in constant motion, this money is also constantly flowing, which makes the possibility for success greatly magnified and seemingly within your grasp. I use the word seemingly to make an important distinction between the two groups of traders. For those who have learned how to be consistent or have broken through what I call the threshold of consistency, the money is not only within their grasp, They can virtually take it at will. I'm sure that someone will find the statement shocking or difficult to believe, but it is true. There are some limitations, but for the most part, money flows into the account of these traders with such ease and effortlessness that it literally boggles most people's mind. However, for the traders who have not evolved into this into the select group, the word seemingly means exactly what it implies. It seems as if the consistency of ultimate success they desire is at hand or within their grasp, just before it slips away or evaporates before their eyes, time and time again. The only thing about trading what is that is consistent with the group is emotional pain. Yes, they certainly have moments of elation, but it's not an exaggeration to say that most of the time they are in a state of fear, anger, frustration, anxiety, disappointment, betrayal, and regret. So, what separates these two groups of traders? Is it intelligence? Are the consistent winners just plain smarter than everyone else? Do they work harder? Are they better analysts? Or do they have access to better trading system? Do they possess inherent personality characteristics that made it easier for them to deal with the intense pressure of trading? All of these possibilities sound quite plausible, except when you consider that most of the trading industry's failure are also some of society's brightest and most accomplished people. The largest group of consistent losers is composed primarily of doctors, lawyers, engineers, scientists, CEOs, wealthy retirees, and entrepreneurs. Furthermore, most of the industry's best market analysts are the worst traders imaginable. Intelligence and good market analysis can the road to success certainly contribute to success, but they are not the defining factor that separate the consistent winners from everyone else. Well, if it isn't intelligence or better analysis, then what could it be? Having worked with some of the best and some of the worst traders in the business and having helped some of the worst become some of the best, I can state without a doubt that there are specific reasons why the best trader consistently outperform everyone else. If I had to distill all the reasons down to me, I'd simply say that the best traders think differently from the rest. I know that doesn't sound very profound, but it does have profound implication if you consider what it means to think differently. To one degree or another, all of us think differently from everyone else. We may not always be mindful of this fact. It seems natural to assume that other people share our perception and interpretation of events. In fact, this assumption continues to seem valid until we find ourselves in a basic fundamental disagreement with someone about something we both experienced. Other than our physical features, the way we think is what makes us unique, probably even more unique than our physical features do. Let's go back to traders. What is different about the way the best traders think as opposed to how these how those who are still struggling think? While the market can be described as an area of endless opportunities, they simultaneously confront the individual with some of the best, most sustained adverse psychological condition you can expose yourself to. At some point, everyone who trades learns something about the markets that will indicate when opportunity exists. But learning how to identify an opportunity to buy or sell does not mean that you have learned to think like a trader. The defining characteristics that separates the constant winners from everyone else is the winner and above all confident in spite of the adverse condition, and as a result they are no longer susceptible to the common fears and trading errors that plague everyone else. Everyone who trades end up learning something about the markets. Very few people who trade ever learn the attitudes that are absolutely essential to becoming a consistent winner. Just as people can learn to perfect the proper techniques for the swinging a golf club or a tennis cricket, their consistency or lack of it will without a doubt come from their attitude. Traders who make it beyond the threshold of consistency usually experience a great deal of pain, both emotional and financial, before they acquire the land of attitude. that allows them to function effectively in the market environment. The rare exceptions are usually those who were born into successful trading families or have who have started their trading career under the guidance of someone who understood the true nature of trading and, just as important, knew how to teach it. Why are emotional why are emotional pain and financial disaster common among traders? Why this is happening? I have experienced it. Let's find out what's the reason behind it. Okay. Hmm. Sorry. Common traders. Okay, the simple answer is that most of us weren't fortunate enough to start our trading careers with the proper guidance. However, the reason go much deeper than this. I have spent the last 17 years dissecting the psychological dynamics behind trading so that I could develop effective methods for teaching the principle of success. What I have discovered is that trading is chock full of paradoxes and contradiction in thinking that make it extremely difficult to learn how to be successful. In fact, if I had to choose one word that encapsulates the nature of trading, it would be paradox. According to the dictionary, a paradox is something where we. Mm, okay, we have covered that one. I forgot where exactly we were. Okay, we have understood the example of Earth and Moon. Hmm. The defining characteristics that suppress the consistent. Other than our physical features, the way we think is what makes us unique. Probably even more unique than our physical features too. Okay. Furthermore, most of the industry's best market analysis are the worst traders imaginable. Intelligence and good market analysis can the road to success certainly contribute to success, but they are not the defining factors that separate the consistent winners from everyone else. Well, if it isn't intelligence or better analysis, then what could it be? Having worked with some of the best and the worst traders in the business and having helped some of the worst become best, some of the best, I can state without a doubt that there are specific reasons why the best traders consistently outperform everyone else. If I had to distill all the reasons down to me, I would simply say that the best traders think differently from the rest. I know that doesn't sound very profound, but it does have profound implication if you consider that what it means to think differently. To one degree or another, all of us think differently from everyone else. We may not always be mindful of this fact. It seems natural to assume that other people share our perception and interpretation of events. In fact, this assumption continues to seem valid until we find ourselves in basic fundamental disagreement with someone about something we both experience. Other than our physical features, the way we think is what makes us unique, probably even more unique than our physical features do. Let's get back to traders. What is different about about die way the best traders think, as opposed to how those who are still struggling think. While the markets can be described as an area of endless opportunity, they simultaneously confront the individual with some of the most sustained adverse psychological condition you can expose yourself to. At some point, everyone who trades learns something about the market that will indicate when opportunities exist. But learning how to identify an opportunity to buy or sell does not mean that you have learned to think like a trader. The defining characteristics that separates the consistent winners from everyone else is the winners have attained the mindset, onyx set of attitudes that allows them to remain disciplined, focused, and above all, confident in spite of the adverse condition. And as a result, they are no longer susceptible to the common fears and trading errors that plague everyone else. Everyone who trades end up learning something about the markets. Very few people who trade ever learn the attitudes that are absolutely essential to becoming a consistent winner. Just as people can learn to perfect the proper technique of swinging a golf club or tennis racket, the consistency or lack of it will, without doubt, come from their attitude. Traders who make it beyond the threshold of consistency usually experience a great deal of pain, both emotional and financial, before they acquire the land of attitude that allows them to function effectively in the market environment. The rare exceptions are usually those who were born into successful trading families or who started their trading careers under the guidance of someone who understood the true nature of trading and, just as important, knew how to teach it. Why are emotional pain and financial disaster common among traders? The simple answer is the most of us weren't fortunate enough to start our trading careers with proper guidance. Or the reasons go much deeper than this. I spent the last 17 years discussing the psychological dynamics behind trading so that I could develop effective methods for teaching the principle of success. I have discovered in the trading is chock full of paradoxes and contradiction in thinking that may make it extremely difficult to learn how to be successful. In fact, if I had to choose one word that encapsulates the nature of trading, it would be paradoxes. Paradox. According to the dictionary, a paradox is something that seems to have contradictory qualities or that is contrary to common belief or what generally makes sense to people. Financial and emotional disasters are common among traders because some of the perspective, attitudes, and principles that would otherwise make perfect sense and work quite well in our daily lives have the opposite effect in the trading environment. They just don't work. Not knowing this, most traders start their careers with a fundamental lack of understanding of what it means to be a trader, the skills that are involved, and the depth to which those skills need to be deployed. Here is a prime example of what I am talking about. Is inherently risky. To my knowledge, no trade has guaranteed outcome. Therefore, the possibility of being wrong and losing is always present. So, when you put on a trade, can you consider yourself a risk trader? Even though this may sound like trick question, it is not. The logical answer to the question is unequivocally yes. If I change or engage in an activity that is inherently risky, then I must be a risk taker. This is a perfect reasonable assumption for any trader to make. In fact, not only do virtually all traders make this assumption, but most traders take pride in thinking themselves as risk takers. The problem is that this assumption couldn't be further from the truth. Of course, any trader is taking a risk when you put on a trade, but that doesn't mean that you are correspondingly accepting that risk. In other words, all traders are risky because outcomes are probable, not guaranteed. But do most traders really believe they are taking a risk when they put on a trade? Have they really accepted that the trade has a non guaranteed probable outcome? Furthermore, have they fully accepted the possible consequences? The answer is unequivocally no. Okay, from here, I'll read out a short break. Okay, so the answer is unequivocally. See, unequivocally simply means unanimously. Okay, the answer is or definitely kind of situation in this context. The answer is unequivocally no. Most traders have absolutely no concept of what it means to be a risk taker in the way a successful trader thinks about risk. The best traders not only take the risk, they have also learned to accept and embrace that risk. There is a huge psychological gap between assuming you are a risk taker because you put on a trade and fully accepting the risk inherent in each trade. When you fully accept the risk, it will have profound implication on your bottom line performance. The best traders can put on a trade without the slightest bit of hesitation or conflict, and just as freely and without hesitation or conflict admit it isn't working. They can get out of the trade even with a loss, and doing so doesn't resonate the slightest bit of emotional discomfort. In other words, the risk inherent in trading do not cause the best traders to lose their discipline, focus, or sense of confidence. If you are unable to trade without the slightest bit of emotional discomfort, especially fear, then you have not learned how to accept the risk inherent in trading. This is a big problem because of whatever degree you haven't accepted the risk is the same degree to which you will avoid the risk. Trying to avoid something that is unavoidable will have disastrous effect on your ability to trade successfully. Learning to truly accept the risk in any endeavor can be difficult, but it is extremely difficult for traders, especially that considering what's at stake. What are we generally most afraid of? Besides dying or public speaking, certainly losing money and being wrong both rank close to the top of the list. Admitting we are wrong and losing money to boot can be extremely painful. Hmm. Can be extremely painful and certainly something to avoid. Yet, as traders, we are confronted with these two possibilities virtually every moment we are in trade. Now you might be saying to yourself, apart from the fact that it hurts so much, it's natural to not want to be wrong and lose something. Therefore, it it's appropriate for me to do whatever I can to avoid it. I agree with you, but it is also this natural tendency that makes trading, which looks like it should be easy, extremely difficult. Trading presents us with a fundamental paradox. How do we remain disciplined, focused, and confident in the face of constant uncertainty? When you have learned how to think like a trader, that's exactly what you'll be able to do. Learning how to redefine your trading activities in a way that allows you to completely accept the risk is the key of thinking like a successful trader. Learning to accept the risk is a trading skill. These are very important things, guys. Take a note of it. Learning how to redefine your trading activities in a way that allows you to completely accept the risk is the key to thinking like a successful trader. Learning to accept the risk is trading skill, the most important skill you can learn. Yet it's rare that developing traders focus any attention or expand any efforts to learn it. When you learn the trading skill of risk acceptance, the market will not be able to generate information that you define or interpret as painful. If the information the market generates doesn't have the potential to cause you emotional pain, there's nothing to avoid. It's just information telling you what the possibilities are. This is called an objective perspective, one that is not skewed or distorted by what you are afraid is going to happen or not happen. I'm sure there isn't one trader reading this book who hasn't gotten into trades too soon, before the market has actually generated a signal, or too late, long after the market has generated a signal. What traders hasn't convinced himself not to take a loss, and as a result had it turn into a bigger one, or got out of a winning trades too soon, or found himself in a winning trades but didn't take any profit at all, and then let the trade turns into loser, or moved stop loss closer to his entry only to get stopped out and have the markets go back in his direction. There are but a few of the many errors traders perpetuate upon themselves time and time again. These are not market generated errors. This that is these errors do not come from the market. The market is neutral in the same in the sense that it moves and generates information about itself. Movement and information provide each of us with the opportunity to do something, but that's all. The markets don't have any power over the unique way in which each of us perceives and interprets the information or control of the decisions and actions we take as a result. The errors I already mentioned and many more are strictly the result of what I call faulty trading attitudes and perspectives. Faulty attitudes that foster fear instead of trust and confidence. I don't think I could put the difference between between the consistent winners and everyone else more simply than this. The best traders aren't afraid. They aren't afraid because they have developed attitudes that give them the greatest degree of mental flexibility to flow in and out of trades based on what the market is telling them about the possibilities from its perspective. Very important. I hope you all are getting the gravity and you all are understanding the gravity of these statements that is given in this book. You'll have to learn it sooner or later. You can learn it easy way now, or you can learn it hard way after, blowing out your account and stuff. At the same time, the best traders have developed attitudes that prevent them from getting reckless. Everyone else is afraid to some degree or another. When they are not afraid, they have the tendency to become reckless and to create the kind of experience for themselves that will cause them to be afraid from that point on. Okay, 95% of the trading errors you are likely to make, causing the money to just evaporate before your eyes, will stem from your attitudes about being wrong, losing money, missing out, and leaving money on the table. What I call the four primary trading fears. Absolutely correct. Yet again, wait a second, guys. In PPT, I'm adding the text. Hmm. All right. Now, you may be saying to yourself, I don't know about this. I have always thought traders should have a healthy fear of the market. Again, this is perfectly logical and reasonable assumption. But when it comes to trading, your fears will act against you in such a way that you will cause the very thing you are afraid of to actually happen. Very important. In the beginning of this video, I said no, market only reflect you. Whatever is inside you, market will act as a mirror and it will show you your fears. If you are afraid of being wrong, your fear will act upon your perception of market information in a way that will cause you to do something that ends up making you wrong. When you're fearful, no other possibilities exist. You can't perceive other possibilities or act on them properly, even if you did manage to perceive them, because fear is immobilizing. Physically, it causes us to freeze or run. Mentally, it causes us to narrow our focus or attention to the object of our fear. This means that thoughts about other possibilities as well as other available information from the market gets blocked. You won't think about the rational things you have learned about the market until you are no longer afraid and the event is over. Then you'll think to itself, I knew that. Why didn't I think of it then? Or why couldn't I act on it then? It's extremely difficult to perceive that the source of these problems is our own inappropriate attitudes. That's what makes fears so insidious. Many of the thinking patterns that adversely affect your trading are a function of the natural ways in which we were brought up to think and see the world. These thinking patterns are so deeply ingrained that it rarely occurs to us that the source of our trading difficulty is internal, derived from our state of mind. Indeed, it seems much more natural to see the source of our problem as external in the market because it feels like the market is causing us pain, frustration, and dissatisfaction. Obviously, these are abstract concepts and certainly not something most traders are going to concern themselves with. Yet, understanding the relationship between beliefs, attitude, and perception is as fundamental to trading as learning how to serve it is to tennis, or as learning how to swing a club in golf. Put another way, understanding and controlling your perception of market information is important only to the extent that you want to achieve consistent result. Hmm. I say this because there is something else about trading that is as true as the statement I just made. You don't have to know anything about yourself or the markets to put on a winning trade. Just as you don't have to know the proper way to swing a racket or golf club in order to hit a good shot from time to time. The first time I played golf, I hit several good shots throughout the game, even though I hadn't learned any particular technique, but my score was still over 120 for 18 holes. Obviously, to improve my overall score, I need to learn technique. Of course, the same is true for trading. We need technique to achieve consistency. Great. If you are perceiving trading as marathon, then you have to do it. In case you are just here to, try your luck once or twice, then it's completely fine. You can do anything. But what technique? This is truly one of the most perplexing aspect of learning how to trade effectively. If you aren't aware of or don't understand how our beliefs and attitude affect our perception of market information, it'll seem as if it is the market's behavior that is causing the lack of consistency. As a result, it would stand to reason that the best way to avoid losses and become consistent would be to learn more about the markets. This bit of logic is a trap that almost all traders fall into at some point, and it seems to make perfect sense. But this approach doesn't work. The market simply offers too many, often conflicting variables to consider. Furthermore, there are no limits to the market's behavior. It can do anything at any moment. As a matter of fact, because every person who trades in a market variable, it can be said that any single trader can cause virtually anything to happen. This means that no matter how much you learn about the market behavior, no matter how brilliant an analyst you become, you will never learn enough to anticipate every possible way that the market can make you wrong or cause you to lose money. So, if you are afraid of being wrong or losing money, it means you will never learn enough to compensate for the negative effects these fears will have on your ability to be objective and your ability to act without hesitation. Hmm. In other words, you won't be confident in the face of constant uncertainty. The hard, cold reality of trading is that every trade has an uncertain outcome. Unless you learn to completely accept the possibility of an uncertain outcome, you'll try either consciously or unconsciously to avoid any possibility you define as painful. In the process, you'll subject yourself to any number of self generated costly errors. Now, I'm not suggesting that we don't need some form of market analysis or methodology to define opportunities and allow us to recognize them. We certainly do. However, market analysis is not the path to consistent result. It will not solve the trading problems created by lack of confidence, lack of discipline, or improper focus. When you operate from the assumption that more or better analysis will create consistency, you'll be driven to gather as many market variables as possible into your arsenal of trading tools. But what happens then? You're still disappointed and betrayed by the markets time and again because of something you didn't see or give enough consideration to. It'll feel like you can't trust the markets, but the reality is you can't trust yourself. It's you, it's always you. Confidence and fear are contradictory states of mind that both stem from our beliefs and attitudes. To be confident functioning in an environment where you can easily lose more than you intend to risk requires absolute trust in yourself. However, you won't be able to achieve that trust until you have trained your mind to override your natural inclination to think in ways that are counterproductive to being a consistently successful trader. Learning how to analyze the market's behavior is simply not the appropriate training. You have two choices. You can try to eliminate risk by learning about as many market variables as possible. I call this the black hole of analysis. It is FHP, NAFH, NF, ultimately frustration. Okay. Or you can learn how to redefine your trading activities in such a way that you truly accept the risk and you're no longer afraid. When you have achieved a state of mind where you truly accept the risk, you won't have the potential to define and interpret market information in painful ways. When you eliminate the potential to define market information is in painful ways, you also eliminate the tendency to rationalize, hesitate, jump the gun, hope that the market will give you money, or hope that the market will save you from your inability to cut your losses. Basically, you'll not play on your luck. As long as you are susceptible to the lands of errors that are the results of rationalizing, justifying, hesitation, hoping, and jumping the gun, you'll not be able to trust yourself. If you can't trust yourself to be objective and to always act in your own best interest, achieving consistent result will be next to impossible. Okay. Hmm. As long as you're susceptible to the lands of errors that are the results of rationalizing, justifying hesitation, hoping, and jumping the gun. Jumping the gun basically means FOMO traits, FOMO entries. You'll not be able to trust yourself. If you can't trust yourself to be objective and to always act in your own best interest, achieving consistent result will be next to impossible. Okay, let me add another page. Okay, electricity. Trying to do something that looks so simple may well be the most exasperating thing you will ever attempt to do. The irony is that when you have the appropriate attitude, when you have acquired a trader's mindset and can remain confident in the face of constant uncertainty, trading will be as easy and simple as you probably thought it was when you first started it. Okay. So, what is the solution? You'll need to learn how to adjust your attitudes and beliefs about trading in such a way that you can trade without a slightest bit of fear, but at the same time keep a framework in place that does not allow you to become reckless. That's exactly what this book is designed to teach you. As you move ahead, I'd like you to keep something in mind. The successful trader that you want to become in is a future projection of yourself that you have to grow into. Growth implies expansion, learning, and creating a new way of expressing yourself. This is true even if you are already a successful trader and you are reading this book to become more successful. Many of the new ways in which you will learn to express yourself will be in direct conflict with ideas and beliefs you presently hold about the nature of trading. You may or may not already be aware of some of these beliefs. In any case, what you currently hold to be true about the nature of trading will argue to keep things just the way they are, in spite of your frustration and unsatisfying results. These internal arguments are natural. My challenge in this book is to help you resolve these arguments as effectively as possible. Your willingness to consider that other possibilities exist, possibilities that you may not be aware of or may not have given enough consideration to, will obviously make the learning process faster and easier. Okay, great. So that's more like a context. So in today's video, we have learned about the basic idea how the emotions plays a very important role. How staying in your system, staying in the rules, and staying you know stoic against all the emotions that you have will ultimately make you a consistent. profitable trader. It's not a one day game. You have to acquire this skill if you want to successfully survive here too long enough that you are going to term as a successful trader, and it will give you the easiness while trading, while putting on your entries and exit the way you perceived it the first time when you get to know about the trading. Okay, so yes, by this we are coming to the end of this video. In the next video, in the next, what I can say, series, or in the next video of this particular series, we are going to cover the chapter 2, which says about the law and the dangers of trading. What exactly attracts you during the trading, and what are the dangers of trading. You should know where exactly you're bleeding to stop the bleeding, right? So that's what we are going to learn in the next chapter. So if you have come so far, thank you so much. Leave a like, and if you have any doubts, put it in the comment section. Thank you so much, universe. Thank you so much, Radharani ji. Have a great day ahead. Peace out.